Today we are exploring a fundamental masterwork for anyone looking to navigate the financial markets with clarity, discipline, and skill. We are diving into a detailed, story-driven breakdown of Getting Started in Technical Analysis by Jack Schwager. If you have ever opened a price chart and felt completely overwhelmed by all the squiggly lines, green and red bars, and confusing indicators, you are not alone. It can feel like trying to read an ancient language without a dictionary, but Jack Schwager, renowned for his interviews with the world's top traders, wrote this book to act as the ultimate roadmap for beginners and intermediate traders alike. Grab your favorite drink, settle in, and let us break down how to read the pulse of the market and build a reliable trading edge. The journey of understanding the price chart. Let us start our story by meeting a beginner trader named Alex. Alex has saved up some capital and is eager to trade financial markets. Like many beginners, Alex initially thinks that fundamental news, earnings reports, and macroeconomic forecasts are all that matter. He buys a stock because a company releases a fantastic earnings report, only to watch in horror as the price immediately plunges. Confused and frustrated, Alex realizes he is missing a critical piece of the puzzle. He is looking at what should happen in theory, rather than what is actually happening in reality. This is where technical analysis enters the picture. Technical analysis is not about predicting the future with a crystal ball. It is the study of human behavior, collective psychology, and supply and demand dynamics, all recorded visually on a chart. Jack Schwager explains that market prices move because of the shifting balance between buyers and sellers. When buyers are more aggressive than sellers, prices go up. When sellers are more aggressive, prices fall. A price chart is simply a living, breathing footprint of human emotions like greed, fear, hope, and regret. By learning to read these footprints, Alex stops guessing where the market ought to go and starts following where the money is actually flowing. Schwager emphasizes that technical analysis provides three major advantages. First, it offers a concrete way to identify trends early. Second, it gives you precise entry and exit points for your trades. Third, and most importantly, it provides an objective framework for managing risk so a single bad decision does not wipe out your account. The foundation of trends and support and resistance. As Alex begins his journey into technical analysis, the very first concepts he encounters are trends, support, and resistance. These are the bedrock of chart reading. Imagine a river flowing downhill. It might twist and turn around rocks, flow sideways through quiet pools, or speed up around steep bends, but the overall movement is steadily downward. A market trend works the exact same way. An uptrend is simply a series of higher highs and higher lows, showing that buyers are continuously willing to step in at higher prices. A downtrend is a series of lower highs and lower lows, indicating that sellers are in total control. A sideways market, or consolidation, occurs when buyers and sellers are in a temporary tug-of-war with no clear winner. Jack Schwager reminds us of the classic market wisdom: the trend is your friend until it bends. Trying to buy in a fierce downtrend or sell in a strong uptrend is like trying to catch a falling knife or stand in front of a freight train. Within these trends, two invisible forces govern price movement: support and resistance. Think of support as a sturdy wooden floor. As the price falls toward this floor, buyers perceive the asset as a bargain and step in to purchase it, while sellers hesitate to part with it at lower prices. This surge in demand causes the falling price to bounce upward off the floor. Resistance is like a hard concrete ceiling. As the price rises toward this ceiling, sellers see a great opportunity to lock in profits, while buyers become reluctant to pay higher prices. This surge in supply causes the rising price to hit the ceiling and drop back down. Here is where the magic happens for Alex. When a price manages to break through a resistance ceiling with high momentum, that old ceiling magically flips to become a new support floor. Conversely, when a price smashes down through a support floor, that old floor becomes a new resistance ceiling. Understanding this simple concept allows traders to align themselves with the path of least resistance. Decoding chart patterns and reversals. Now that Alex understands trends, support, and resistance, he begins to see repeatable geometric shapes forming on his price charts. These are chart patterns, and they represent classic psychological battles between buyers and sellers. Schwager divides these patterns into two main categories: continuation patterns and reversal patterns. Continuation patterns tell you that the market is just taking a temporary breather before resuming its original trend. Imagine a long-distance runner stopping for a brief sip of water before sprinting forward again. Shapes like flags, pennants, and triangles often represent these healthy pauses. When the price breaks out of a flag pattern in the direction of the underlying trend, it provides a high probability signal that the journey is continuing. Reversal patterns, on the other hand, warn you that the current trend is losing steam and about to change direction entirely. One of the most famous reversal patterns is the head and shoulders. Picture a mountain climber trying to reach new peaks. The climber reaches a high point, which forms the left shoulder, and pulls back slightly. Feeling energized, the climber pushes higher to reach a new peak, forming the head, but again pulls back to a baseline known as the neckline. The climber makes one final desperate push upward, but can only reach a lower peak, forming the right shoulder. When the price breaks down through the neckline baseline, it signals that the buyers are completely exhausted, and the trend has officially reversed into a downtrend. By recognizing these patterns as they unfold, Alex learns not to get caught off guard by sudden market shifts. He waits patiently for the market to confirm these shapes before risking his hard-earned money. The truth about technical indicators and oscillators. As Alex dives deeper, he discovers thousands of mathematical tools called technical indicators and oscillators. Excited by all these sophisticated tools, Alex makes a classic beginner mistake. He clutters his chart with dozens of moving averages, stochastic oscillators, relative strength indexes, and trend channels. His screen looks like a neon fireworks show, and ironically, he becomes completely paralyzed by conflicting signals. One indicator tells him to buy, while another tells him to sell. Jack Schwager steps in with a dose of reality. Indicators are not magic indicators of future wealth. They are simply mathematical derivations of price and volume data. They follow price. Price does not follow indicators. Schwager breaks indicators down into two primary types to help Alex simplify his setup. First, there are trend-following indicators, such as moving averages. A simple moving average calculates the average price of an asset over a set number of periods, like 50 or 200 days, smoothing out the daily noise to reveal the underlying direction. Moving averages work brilliantly in trending markets, helping you stay on board as long as the price remains above the line. However, in sideways markets, moving averages fail miserable, giving false signals left and right. Second, there are momentum oscillators, such as the relative strength index or stochastics. These tools measure the velocity of price movements and oscillate between 0 and 100. They help identify overbought conditions, where prices have risen too far too fast, and oversold conditions, where prices have plunged too sharply and are due for a bounce. Oscillators shine in range-bound markets, but in strong, runaway trends, an asset can remain overbought for weeks, causing premature short positions for naive traders. The lesson for Alex is clear: keep it simple. Indicators should be used as secondary confirmation tools to support what price action, support, resistance, and volume are already telling you, rather than as primary decision makers on their own. The power of trading systems and rules. After learning about trends, patterns, and indicators, Alex feels like he has plenty of knowledge. But when he starts executing live trades, he hits a wall. He finds himself making emotional decisions. He sells too early out of fear, holds on to losing trades out of hope, and chases skyrocketing prices out of greed. Knowledge alone is not enough. Alex needs a mechanical, rules-based trading system. Jack Schwager stresses that a trading system is simply a strict set of rules that defines exactly when to enter a trade, when to exit with a loss, when to take profits, and how much capital to allocate to the position. A good system removes gut feelings, guesswork, and emotional turbulence from the equation. Schwager explains that designing a trading system requires testing your rules against historical price data to see if they hold an actual statistical edge over time. Does your strategy yield a positive expectancy? In other words, over a sample of 100 trades, does the total dollar value of your wins exceed the total dollar value of your losses? Many beginners foolishly try to build a system with a 90% win rate. They hate being wrong. But Schwager reveals a shocking secret from top traders. Many of the world's greatest traders only win 40 to 50% of their trades. Their secret is not win frequency, it is win magnitude. When they are wrong, they lose a tiny amount. When they are right, they make 3, 4, or 5 times what they risked. A trading system transforms Alex from an emotional gambler into a disciplined business owner, executing a proven statistical plan. The golden rule of risk management and capital preservation. Now we reach the absolute core of Jack Schwager's philosophy. You can master every chart pattern in existence and build a brilliant trading system, but if you do not understand risk management, you are guaranteed to blow up your account eventually. Let us compare two traders, Alex and Ben. Both start with $10,000. Alex uses proper risk management, risking only 1% of his account on any single trade, which equals $100. Ben, driven by greed and a desire to get rich quick, risks 20% of his account per trade, or $2,000. Both traders encounter an unavoidable losing streak of 5 trades in a row. Losing streaks are a mathematical certainty in trading. After 5 consecutive losses, Alex has lost $500. His account stands at $9,500. He needs a tiny 5% gain to get back to his starting point. He remains calm, composed, and in total control. Ben, on the other hand, suffers a catastrophe. After 5 losses at 20% each, his account is devastated. He has lost thousands of dollars and is down to a fraction of his original capital. To get back to even, Ben needs a massive, near-impossible return just to recover his losses. Desperate to make his money back, Ben takes on even more risk, makes emotional trades, and completely wipes out his remaining funds. Schwager emphasizes the concept of mathematical asymmetry when it comes to losses. A 10% loss requires an 11% gain to break even. A 50% loss requires a massive 100% gain just to get back to where you started. A 90% loss requires a mind-boggling 900% return to break even. This is why capital preservation is rule number 1. Your stop-loss order is your ultimate insurance policy. A stop-loss is a predetermined order that automatically exits your trade if the market moves against you by a specific amount. Placing a stop-loss is not admitting defeat. It is paying a small premium to protect your business from catastrophic failure. Schwager advises never risking more than 1 to 2% of your total equity on a single trade, ensuring that no single mistake or bad streak can ever knock you out of the game. Psychology, discipline, and execution. As Alex refines his risk management, he realizes that his biggest opponent in the market is not the market maker, the algorithm, or the economic environment. His biggest opponent is looking back at him in the mirror. Technical analysis is simple, but execution is difficult because human psychology is naturally wired to sabotage trading success. When a trade goes into a loss, normal human psychology feels hope. We hope and pray that the market turns around, so we move our stop-loss further away or remove it entirely, turning a manageable minor loss into a devastating disaster. When a trade goes into a profit, normal human psychology feels fear. We fear losing our small gain, so we jump out of the trade far too early, missing out on massive winning trends. To become a successful technical analyst and trader, Alex must completely flip his natural human instincts. He must learn to fear large losses and cultivate hope only when his winning trades are running smoothly in his favor. Jack Schwager highlights that elite traders treat execution like a cold, calculating discipline. They accept that loss is a normal, unavoidable cost of doing business, just like rent for a brick-and-mortar shop or electricity for a factory. They do not get euphoric when they win, and they do not get depressed when they lose. They focus entirely on executing their plan flawlessly, knowing that the probabilistic edge of their system will play out over time. Discipline means taking every valid signal your system generates, adhering strictly to your position sizing, and honoring every stop-loss without hesitation or regret. Developing your personal trading strategy. As we near the conclusion of Alex's transformation, he understands that there is no single best way to trade that suits everyone. What works for an institutional day trader will not work for a busy professional who can only look at charts for 20 minutes every evening. Jack Schwager encourages every trader to build a personal strategy that fits their individual personality, risk tolerance, time availability, and emotional temperament. If you are a calm, patient person who enjoys big-picture analysis, daily or weekly swing trading and trend following using simple chart patterns and moving averages might be your ideal style. If you thrive on quick decisions and high activity, shorter timeframe intraday trading might suit you better, though it comes with higher stress and transaction costs. Schwager provides a clear step-by-step process for personal strategy development. First, select your primary timeframes. Always analyze a higher timeframe, like a weekly or daily chart, to identify the main trend direction, and use a lower timeframe, like a 4-hour or 1-hour chart, to fine-tune your entry points. Second, define your setup criteria. What specific combination of price action, support levels, or pattern breakouts must be present before you even think about entering a position? Third, establish your risk parameters. Determine where your stop-loss will be placed based on technical levels on the chart, not arbitrary dollar amounts, and calculate your exact position size so your potential loss stays under 2% of your account. Fourth, plan your exit strategy. Where is your profit target? Will you use a trailing stop-loss to ride a long trend, or will you take profits at major historical resistance levels? Fifth, keep a detailed trading journal. Document every single trade you make, with screenshots, entry and exit prices, the rationale behind the trade, and your emotional state. Reviewing your journal regularly allows you to spot your recurring mistakes, refine your rules, and continuously improve your performance over time. The ultimate blueprint for market mastery. Let us look back at the journey Alex has taken, and the blueprint Jack Schwager provides to all of us. Technical analysis is not a magical crystal ball, nor is it a guaranteed road to instant wealth. It is a structured, disciplined framework for interpreting market psychology, managing risk, and tilting the odds of success in your favor over time. By taking price action seriously, respecting support and resistance levels, keeping indicator usage simple, enforcing strict risk management, and mastering your own internal psychology, you convert trading from an unpredictable gamble into a probability-based profession. You learn to stop chasing the noise of the financial headlines, stop listening to social media gurus, and start trusting the clear, objective reality displayed on the price chart in front of you. You accept that you cannot control what the market does next, but you have total control over your risk, your actions, and your discipline. Thank you so much for spending your valuable time with me today, exploring the timeless principles inside Getting Started in Technical Analysis by Jack Schwager. If this breakdown gave you new insights into chart reading and trading discipline, please hit the like button, subscribe to